So for those of you who attended either my sessions about short-term rentals or any other sessions about short-term rentals, as a very quick recap, the short-term rental loophole is not actually a loophole. It's just straight up in the tax code. Short-term rentals are considered non-residential because they're transient in nature. So they're non-residential, and non-residential rentals can be treated as passive or non-passive. So if they meet the criteria to treat it as non-passive, and to be clear, it's not active. Active is different than non-passive. STRs can be treated as non-passive, which is what allows the losses to offset other ordinary income. Now, when the short-term rental is held in a partnership, things change a little bit. So unless substantial services are provided, and substantial services are things like cleaning during the stay, so not in between stays, even if you have tenants switch out every 3 days and you clean in between, that's not substantial services. Substantial services are like a hotel where they'll come and clean every day of your stay, right? So assuming no substantial services, that means the short-term rental reports on Schedule E, not on Schedule C. Not on Schedule C. Even if it's non-passive, still Schedule E, not subject to self-employment tax. Schedule E, non-passive. For a partnership, rental properties report on 8825. That's the partnership version of a Schedule E. So short-term rental would report on 8825. But even if there is material participation, it's not typical that both partners will be able to qualify to treat that short-term rental as non-passive because there are tests, right? You have to have performed at least X number of hours and more than anyone else, or you have to have participated at least 500 hours in that activity, etc., right? There's like 7 main tests for material participation. It's going to be very hard for both partners in a partnership that owns 1 or 2 short-term rentals to both qualify for material participation. So it gets a little bit tricky when a partnership is involved. You're still going to report it on 8825, but then the determination for whether it's treated as non-passive or not is actually going to happen at the partner level, not at the partnership level. That might not make a whole lot of sense right now if you don't do a lot of rental property stuff, but if you do, and if you have a partnership that has a short-term rental, just remember the determination for whether it's going to offset other ordinary income is going to happen for each partner separately. And it's pretty unlikely that they're both going to meet the tests, especially if there's only 1 or 2 short-term rentals involved. So yeah, hope I didn't lose anyone on that one. Let's see, here was another one that came up. Client owns, oops, Jesus, I gotta quit clicking. Owns a 4-bedroom home and rents out 3 of the rooms to non-family at fair market value. He receives $600 per month from each tenant. How do I report the number of fair rental days on the Schedule E? So the question was about the fair rental days on Schedule E, but that also leads into, because I think their thing was a lot of softwares will use the fair rental days to calculate the percentage of business use, right? So in this case, that's a little wonky because those rooms were rented 365 days, right? So that's not going to be how the percentage of business use is determined. It could still be 365, fair rental days, but there's still going to have to be some proration that happens. So I saw some answers that said it's 4 bedrooms, 3 of them are rented out, so 75% of the expenses are business and 25% are personal. I don't agree with that because there are also commonly shared spaces, right? Kitchen, living room, bathrooms. So I think a more appropriate approach would be to take the total square footage of the house and then the square footage for the 3 rental bedrooms and come up with the proration that way. So in my example, I said a 2,500 square foot house. The 3 bedrooms total to 1,200 square feet. That makes it 48% business use. So that's a very high level example. It can get a lot more convoluted than that, but just know that you may have to override your software's business use calculation because that 365 days could be accurate, but that doesn't make 100% of the expenses deductible as rental expenses. So I thought that was kind of a fun question. Here was another one. You have a married filing joint couple they sold their primary residence for less than a 500K gain. They did not receive a 1099-S. So do you even report the sale of the residence and claim the 121 exclusion? I say yes. I like to have it documented, and that way there's no question. It could be that there was a 1099-S issued and they just for some reason didn't receive it, and then that could eventually lead to a notice. But for me, if the sale happened and a sale of a residence is supposed to be reported, then even in the absence of a tax form, I'm still going to report it. Remember, receiving a tax form isn't what makes a transaction reportable or even taxable. So I would personally report it anyway, and then I would report the Section 121 exclusion. What about you guys? Anyone disagree?
I report.
No, I do the same. And for some reason, escrow company, they don't send the 1099-S, but they filed it with the IRS.
Right.
I don't know why they don't send it.
I'm sitting here at my client's office. I just got a letter in the mail today from their attorney that's dated December 1st, and it just showed up today, February 6th. So not having the 1099-S doesn't mean it wasn't sent. It could just be floating around in the postal service that is a flaming hot mess right now.
But it could also be sitting inside of all the paperwork they get when they close on the property. That's where I find it a lot of times.
That's a good point. Yeah, it could have been part of their closing packet.
Yeah.
Or like the final version of the closing packet.
I always ask for a complete copy of that because usually it can be emailed to me and I look through it and sure enough, there's the 1099-S.
Great point. All right. I saw somebody post, I heard that IRS will start allowing deductions for pet expenses. Is that correct? I mean, I love my dog like a child. I would love to be able to claim her as a dependent. Her food is expensive because she's a diva. And she likes cute coats and clothes and stuff. So I'd love to be able to claim her, vet expenses and whatever. So I don't know. I haven't read up on, and in full disclosure, I haven't read up on recent legislation on this. So I don't know that it's new. You can claim pet-related expenses for certified service animals. And I feel like that was always the case, though they would have had to be claimed as like medical. And so you would only deduct it if you itemized and then exceeded the floor for medical deductions. But Marianne Bracino responded to that post and pointed out that this applies to certified service animals or animals used in the production of income. She also pointed out that certified service animals are just that. They are certified service animals. They're not the emotional support animal that you got the certificate online. You see those walking all over the airport these days. Those aren't the type we're talking about. Those are still non-deductible.
Thanks for watching. If you found this session helpful, we invite you to join our Pronto Tax School memberships. You'll get access to weekly live mentor support sessions like this one, plus tons of advanced tax course trainings, private groups, special discounts to in-person events, a tax business growth coach, and so much more. Check the links in the description to learn more about our Dream Team and Forever Edition memberships, and join us today.